Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday morning, August 19th, 2021. I'm pre-recording this Trading Places Live just a couple of hours early. Futures are currently lower. The Dow futures are down a little more than 300 points, but they are off of their worst levels from overnight. So we'll see how this translates into an open in just a couple of hours, but it does look like the recent selling is likely to continue at the opening bell today. We're going to go through the agenda first. So we're going to start off with daily market recap, as we always do, then jump into talking technically, SCTR Movers, the earnings spotlight, and then we're going to wrap up with the 3 you must see. So let's go ahead and head over to earnings beats here for just one moment before we get started. Just want to invite everybody. A couple things. First of all, we have one of our biggest webinars of the quarter later today. It'll start at 5:30 this evening. That's where I'll be announcing the 10 equal weighted stocks that go into each of our 4 portfolios. We do this every 90 days. So tonight it is on tap. This is a members only event, but we do have a 30-day no cost trial. So if you'd like to start a trial and come and join us for this event tonight, we'd love to have you. You can simply click on that button on our homepage and you can join later. And again, this is just earningsbeats.com. Just come over to our website. Also, if you scroll down, we have a free newsletter. This is our Earnings Beats Digest, and it's published 3 times a week, Mondays, Wednesdays, Fridays. No credit card required. You can unsubscribe at any time. It's really an educational newsletter. We normally feature a stock. Many times it's for educational purposes, but also can be for trading if you're interested. All you have to do is type in your name, email address there, hit that subscribe button. We'll make sure we get you added. There's a lot of other perks and benefits to being in our community. We do a lot of free events and we reach out to our community for those events. So let's go ahead and move over to the action on Wednesday. And you can see there was damage done on the charts. The Dow Jones Industrial Average broke down below its 20-day moving average, finishing on its low, down almost 400 points, 382 points, more than 1%. The S&P 500 also losing more than 1%, falling below its 20-day moving average. And then you've got the NASDAQ, which fell on a relative basis. It fell less than the other indices, but still it was already below its 20-day. Now it's threatening its 50-day moving average. In fact, closing just about 10 points below that level. So not a good look there on the NASDAQ. Mid caps, small caps already were weak on a relative basis, and they just got a little bit weaker. Mid caps and small caps both finishing down just a little bit less than 1% on Wednesday. The AD lines, I do want to point out, continue to be pretty strong on all the major indices with one exception, small caps. So I wouldn't read a whole lot into this short-term weakness. I mean, we are in that August, September period. We've talked about this often. This is a period when we definitely can see weakness. It's also options expiration week. And I talk a lot about options expiration and the significance of the time within the calendar month. The market tends to struggle as we get toward option expiration and beyond. I can tell you today being the 19th of the month, that the 19th of all calendar months, the 19th is the worst day of the calendar month historically since 1950. The S&P 500 has an annualized return of minus 30% on the 19th of the month. So definitely worthwhile noting anytime you get close to option expiration around, whether it's the week leading up to it or even into the week following. That's when the market does tend to struggle. Looking at the sectors on Wednesday, discretionary stocks, which if you recall on Tuesday were by far the worst performing group. Well, on Wednesday, they were the only group to finish in positive territory. They were well off their earlier highs where they tried to get back through the 50-day moving average and failed, but did finish up about 1/3 of 1%. The weakest areas, energy, again, down more than 2%. You can see we are definitely looking to head back toward this 46 level. And I'm going to talk about it in a bit, but crude oil is really getting slammed overnight. The commodities down roughly about 3% or so last time I looked. and it was down near $63 a barrel. That's pretty significant breakdown. So energy, we definitely want to keep our eyes on that throughout the day. We're going to see whether or not $46 will hold. That is a support level that I would certainly be looking for to hold. If it doesn't, then I think we're opening the door to lower prices there. Healthcare reversed. Healthcare has been very strong of late, one of the strongest areas of the market, but we did see a lot of profit taking in healthcare on Wednesday. Technology also faltering. Negative divergence here is the thing that's bothersome to me, and certainly suggests that we could see some additional weakness here in the near term. And then staples, after a big run up to the upside, lost about 1.25%. So all four of these sectors here that were weak all lost anywhere from about 1.25% up to a little more than 2%. So very rough day. 10 of 11 sectors down. Again, discretionary, the only group that was up on Wednesday. Let's see, on Thursday morning, I'm going to show you the 10-year Treasury yield here, but on Thursday morning, we'll be waiting just a bit for initial jobless claims due out. Last week, 375,000, expected to be 360,000 this month. August, Philadelphia Fed Manufacturing Index, expected to come in around 25. July was 21.9. And then July leading indicators expected out, and they're expected to come in gaining about 0.8%. June gained about 0.7%. So a slight tick up there in the July leading indicators. As far as the yield goes, I was a little surprised yesterday. And we'll talk about this a little bit when we look at the S&P 500, but the market really had some issues after 2 o'clock when the Fed minutes came out. And there was discussion in the Fed minutes about tapering the Fed's bond purchase program later in 2021. Now, some objected to it. Some were looking maybe into 2022, but the fact that they were discussing it seemed to rattle the market. Now, from my perspective, I believe that it was just a story to grab. Here we are. It's option expiration week. I think you've got market makers that would benefit from the market moving lower. I think they took this story, they ran with it, they shorted the market into the close yesterday. And so I think short term, we're probably in a little bit of a pickle here. Further out, I think the market goes higher. I think this will be a story that's completely gone and fades away shortly. But in the very near term, the market needed something. And I'm going to talk a little bit about that in just a minute. But if the market was truly concerned, now, the stock market took a hit. The bond market, however, if you look at it, now think about the ramifications. So when the Fed buys bonds, they artificially are keeping rates low. So if they talk about tapering that activity, then you would think that the bond market would react with yields rising, right? Everybody would want to get out of bonds before the Fed starts reducing their purchasing of bonds. That's what would make sense to me. When you look at the intraday chart of the 10-year Treasury yield, you see the yield going up in the last hour? Because I don't. I see it going down. So at 2 o'clock when this announcement was made and the stock market reacts negatively because of the potential tapering of bond purchases later this year, why didn't yields go up? Why wasn't there a selling of bonds? I don't have the answer. What I do have the answer for is I don't really think this is that big of a deal. But again, the stock market needs a story. And I want you to just think about this for a minute. We had our Max Payne webinar with our members after the closing bell on Tuesday. The SPDR, the SPY, which tracks the S&P 500, closed at 444.06. Now we went back, we looked at all the open interest for calls and puts on the SPDR. And the point at which all of the in-the-money calls completely offset in-the-money puts. So the point at which there would be no payout on a net basis is 431.31. That's the Max Payne on the SPDR. Closed at 444.06. So we had the potential of dropping close to $13. Now, what I always tell members when we talk about these Max Payne numbers is that I'm not looking for the spider to go down $13 in 3 days. It might happen. It happened in July, and it was a bigger amount. I can show you a daily chart here in just a minute. Actually, let's take a look at that daily chart. We'll come back to this. So this was last month. Here was the Tuesday. We were sitting at about 436, and the max pain was 422.90 or 421.92 or 420. Yeah, it was 421.92 on Monday. Now, we always say, you got to be careful into the beginning of the following week because options can be exercised. So market makers can still be on the other side of the trade even after options expire. Because if you got a lot of in the money calls and folks exercise them, that means they're buying the stock at their strike price. You've got market makers that are shorting. So they're on the other side of that trade still. Anyhow, by Monday, so Tuesday at the close, when we had our meet at our webinar, the spider was at 435.59 with max pain at 421.92. On Monday at the low, 421.97 within a nickel. That was $14 down on the spider in 3 days. I'm not saying that it's not possible, but that's not really what we do max pain for. We're not trying to offer up some kind of guarantee that the stock market's going to go lower, because market makers are still protected even if the price doesn't go down. And the reason they're protected is all of these calls that were bought on the way up, where market makers are on the other side, so they're actually selling the call. There's a covered call strategy. They can sell the call and they can buy the spider. So that's, and I've never worked for a market maker, so I'm speculating to some degree. But if I wanted to protect myself, that's what I would be doing. I'd be selling, the call, but I'd be buying the stock. That's covered call strategy. Anyhow, so $13 worth of downside possibility. And I just want to tell you what each dollar to the downside means in terms of option premium. So as of Tuesday at the close, the net call premium on the spider, forget about all the other ETFs, all the other stocks, all the other index options, everything else that's out there. Just on the spider alone, there was $925 million worth of net call premium. So you got call premium, it's all the in-the-money calls. You got put premium from all the in-the-money puts. The net call premium was not $925 million. Every dollar that the spider drops, that net call premium goes down by $70 million. So when I look at the action on Wednesday, where the spider was down almost $5, that's $350 million of that 925 million that just goes poof, gone. So if you're sitting there holding a spider call and you're way in the money, you just lost a lot of money on Wednesday. And you've got to be aware of what market makers' potential financial interests are. And one of the things that they certainly would appear to be interested in is the market selling off, which is why I talk about this every single month. If you're a trader, you've got to be aware of market makers' interest going into option expiration week. So the news comes out at 2 o'clock yesterday, and quite honestly, is this catching anyone by surprise? Is this not what the market expects at some point, that the Fed is going to be tapering? Is this not already built in to the stock market? But hey, it makes for great headlines. And so now all the headlines, we got futures down 300 points on the Dow overnight. And now it's all about the Fed tapering. Like nobody knew this was coming. I mean, everybody knew it was coming at some point. And like I mentioned, where's the reaction in the bond market? Why is it just the stock market that's reacting to this? It's bond purchases. That's a direct impact on the bond market. Anyhow, I could go on and on. But, you look at this and you see every dollar drop in the spider saves $70 million in net call premium for August. And so down $5. And now let me see futures. Let's see where we're at right now. Futures, I'm looking at S&P 500 futures down roughly 0.75%. So probably another $3, maybe a little over $3 at the open. what's another 210 million among friends, right? Let's line the pockets of the market makers. We know how much they need it, right? Anyhow, just wanted to point that out. You've got to be aware of what's going on around option expiration week. Does this happen every month? No, it does not. But probably isn't the best time to be buying stocks, especially if your stocks have been moving higher into option expiration week, and even more so if those stocks are optionable. Because if a stock's been going up, and it's optionable, chances are it's got a ton of in-the-money call premium and subject to exactly what happened to the S&P 500 yesterday. So if you've got tech stocks, consumer discretionary stocks, stocks that had been doing pretty well and all of a sudden started seeing a sell-off last couple hours yesterday, chances are you've got some option issues that market makers are resolving pretty quickly. Now, the good news is if we do go and look at that daily chart, once options expired and was out of the way, look at this. A week later, we were back at an all-time high. This is a short-term market inefficiency. This is not a long-term market call. This is options expire in a few days. Speaking about Tuesday, of course, now they expire tomorrow. But options expire in just a few days from when we did our webinar. This is a short-term issue. Market makers can make a lot more money if they start selling their long positions and begin shorting the stock. They made money on the long position on the way up. They sell that, then they short. They make money on the shorts on the way down. And guess what? They also make money when all that option premium goes away. It's a win-win-win. It's a little windfall for market makers. So let's make sure they get their little bit of money. Anyhow, I could ramble on about that for a while. Let's talk a little bit about crude oil, because oil right now in pre-market is down $3.56%. It's down $2.33 to 63.13. Now you can kind of see the chart already looking like it's rolling over. I was watching 65 support here from the low in July. But I mean, once we made this big move up, the next drop, which I think is a very significant drop here in March, goes down to about $57 a barrel. I think that's where we're heading based on what I'm seeing here. Now, whether or not the XLE can hang on to support, because I've been watching this 46 level here was 46. When we get down to 46, which I believe we're going to have a positive divergence in play. Do we hold this support? If not, well, next level. Where was that breakout? The breakout came from January. We got up to 44, came back up, put a little cup in, a little handle, and then broke out above 44. And we haven't gone back and tested that. So if we fail at 46, and I believe based on what's going on with crude oil right here, I suspect we're going to fail at 46. I think we're going to go down to this 44 level. And then the question is, do we hold there? I've said recently, I'm not a fan of energy. I'm not a fan of materials. I think the dollar is going to go higher. I think economic strength in the U.S. is going to be stronger than across the globe. And I think the dollar strengthens. And if the dollar strengthens, that presents headwinds for energy and materials. And if we pull up the relative strength on energy, you can see relative weakness has already begun again. We've rolled over. We hit our relative high back at the beginning of March. Since March, energy has been underperforming the S&P 500. Now, you might say, well, yeah, it's still way off the low of November. Let me show you what the real trend is here. We're going to go back 10 years on this chart. Do you see the weakness? I mean, we had a free fall in energy in 2020 during the pandemic on a relative basis. This is almost like a little bit of a dead cat bounce. Now, what I would be watching for on this chart is the possibility of a bottoming relative head and shoulder pattern. Left shoulder, neckline, head, neck, right side of the neckline, and then back down, potentially setting a right shoulder here. That would be the bullish case for energy. But in order for this to play out, you're going to need this dollar to break down below this 88 level, in my opinion. And the dollar is strengthening. And my signals that I follow for the dollar are telling me it's going to continue to strengthen. Now, the one thing you have to understand is when the dollar bottomed all the way back here, I think it was in 2011, and as the dollar moved higher all the way up into 2019, look at what energy did on a relative basis. Struggled. We finally started to see a little bit of bounce there when the dollar was weakening again. But now the dollar's hit support, dollar's turning back up. I just don't see the catalyst here right now, unless I'm wrong about the dollar. Next up is materials. You look at materials. Oh, this is in an uptrend. What are you talking about? Materials are great. Well, let's stretch this out so you can get a look at the real chart on materials. Here's the long-term chart on materials. Now I see lows, reaction highs, new lows, reaction highs, new lows, and this reaction high has not taken out that high. I still see a downtrend in play here, and I think this huge move down the past couple of months was resuming that relative weakness. Now, it doesn't mean we're going to have absolute weakness. We could just go sideways. We could consolidate materials while the market goes higher. That would result in more relative weakness. If you look at all of this weakness here, relative weakness in 2018, 2019, I mean, materials didn't go down. It was just that the market was going up. So if you have money parked in materials, you're underperforming. And that's what you want to avoid. But once again, if I'm right about the dollar moving back to the upside, and I think I'm going to be, we're going to find out. But if I'm right about that, materials and energy, not where you want to be. Let's move on. I want to talk about, I want to go over scooter movers. So what you can do at StockCharts, there's so many cool features at StockCharts, but under the member tools, if you scroll down, you'll find scooter reports. So you click on that. And the default is basically just lines up all of the top ranked scooters among large caps. Now, if you're unfamiliar with scooters, you can go into Chart School. Just go up here into Chart School. When you get to the search, just type in SCTR, scooter, SCTR, and it'll show you a formula, how it's calculated. John Murphy developed it. I'm not going to go into a lot of discussion about what it is. What I will tell you is that the scooter, first of all, it's StockCharts technical rank. So it's based on technicals. It is a formula designed to rank stocks against other stocks within their asset class in terms of relative strength based on the formula. So there are going to be limitations. It's based on a formula. So the primary limitation for me is that it only looks at things that go back about 5 to 6 months. So you can be, for instance, you might be in some materials and it might say, hey, these are the best stocks. I mean, here's a material stock and it's one of the best stocks, but materials have been hot in the short term. You know, if you go back and look at a 10-year chart on steel and on, Nucor, and I haven't done that, but if we pull this up, and actually this has been pretty good throughout the last year, but if we look at a long-term chart, let's see what Nucor has been doing. Yeah, I mean, this is really mostly a 2021 thing. I mean, if you go back the last 10, 15 years, Nucor has gone nowhere. It seems like it goes down when the market goes down, 2008, 2020, but when the market goes up, it doesn't. Now, we've had a huge move up, lots of demand with limited supply because we were coming out of the pandemic, and many commodity stocks benefited from that. But I think that's going to reverse. I think now we're building up our supply and demand, the growth in our economy is not going to be sustainable. So I actually think some of these stocks that have had huge runs better watch out in 2022, maybe later in 2021. But anyway, that I'm kind of digressing here from my point, which is these scooter reports. So anyhow, you got to keep in mind there are limitations. But what I wanted to do is just go over a little bit about a couple of the stocks here on this report. So one was, and I think what I ended up doing was looking at, how did I do this? I think I went back over the last week and I was looking at changes, positive changes. Yeah, that's what I was doing. So let's take a look at Alcon. This is in healthcare. I told you healthcare has been really strong. So Alcon, if you look at the chart, had been sideways consolidating for a while, just made this huge breakout on massive volume. This is a stock absolutely keep on your radar as we go forward. How about another stock, which is Insulet, Pod. So this one also making a huge move in its scooter score. Now, I would be watching it because it's getting very close to a breakout. So while I wouldn't be a buyer right here because we're up against resistance, this is a stock that I'd be very interested in if it were to break out. Notice, even though it hasn't moved to a new high here yet, the AD line has moved to about a 6-month high. So it's cleared the high that we had back in April. So I'm seeing accumulation. We just want to make sure we get that breakout. So this is the scooter reports is just an opportunity to come in, play around with the data and find some stocks that are really starting to move. I'll give you one more here, eBay. Look at eBay going up, making the breakout, big volume. Look at that AD line breaking out. Now it's pulling back the market as it sells off. I haven't looked at options on eBay, but I can promise you that this little pullback is saving market makers money. So if we continue to get some short-term weakness, maybe we get eBay at the 20-day moving average. That would be a pretty good entry point. All right, moving on to earnings. So I wanted to pull up a couple stocks that reported after the bell yesterday. NVIDIA, and we can even take a look, see what it's doing pre-market here. It was up 1% or something like that a little bit earlier. Up $3, almost 2%. So it's doing pretty well this morning. They reported earnings that beat $1.04 versus $1.01. I did not see their revenues. I can only assume they beat on their revenues as well. This is a stock that's been heavily accumulated. Look at the AD line. Even though we haven't gone to new highs, look at the AD line continuing to go higher. And the reason that that's happening is that even though we've seen sell-offs, it's on light volume. So if you have a strong day and there's heavy volume, you have a very strong multiplier, which is where you finish relative to your day's candlestick. If you finish up near the high, you're going to get almost 100% multiplier times the volume. If you finish at the low, you're going to get 100% multiplier times the volume, and you're going to go down. Well, this keeps going higher, so I think it just paints a pretty bullish picture here. One other stock that I wanted to mention actually reported this morning was Macy's. Macy's didn't see their earnings because they just reported this morning, but this is a stock that, the AD line very close to about a 6-7 month high. It's been sideways consolidating. It's up 4% this morning pre-market. Now, it's not going to be enough to break out, but this is a stock to watch, in my opinion. It is in broadline retail. We're seeing Amazon do this. Target's been going crazy, but most of the broadline retailers have been struggling, going sideways. But let's see what happens with Macy's later today and in the weeks ahead. I think we're going to get a breakout here with Macy's going forward. Anyhow, let's move on to the 3 you must see. And all I did on this, I just selected the 3 worst performers on the S&P 500 yesterday. Let's just take a look and see what they look like. So OGN, Organon, had a huge move. That is a bearish engulfing candle. I don't know if they have options or not. I don't know if it's optionable, but I would be careful. I think this could fall back to test that 20-day, possibly even this gap support where that volume picked up right around 31. I'd watch for that. Next stock was, that was STE, which is Steris. Steris had made a breakout, came back down. Maybe it's options related. I'm not sure. I think if we fall back close to that 50-day moving average, I believe the stock will pick back up again. AD line just kind of so-so on this one. And then the last one, AMD. Now, AMD has taken off over the course of the last month, but it's pulled back, and I would bet that this has something to do with options. I think if you get this stock back down into the 95 to 97 range, that this would be a pretty good trade. And AMD is back down below its 20-day. So watch anything below 100. I think that starts to get interesting. All right, that's it for me today. Appreciate everybody tuning in. I'll be back on Monday for your next Trading Places Live over at earningsbeats.com. And remember, got our big event tonight. Go to Earnings Beats, sign up for our trial, and check out our top 10 stock picks tonight. Have a great day, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.